Now, if you've recently thought to yourself, I wonder if I can retire yet, the odds are that you might be a lot closer than you think, because there are just 5 questions that if you can answer yes to, you might be able to retire right now. So in this video, I'll break down each question and explain what you actually need to retire, so you can find out if you're ready now or if you should wait a few years. Question 1. Have you paid into pensions most of your working life? You see, this might sound a little obvious, but you'd be surprised at how many people don't actually know how long they've been paying into pensions, and you'd also be surprised at how many more people don't know how this could impact their chances of retirement. So to find out the answer to this, you need to understand your history of pension contributions. When answering, consider the following: the length of time you've consistently contributed to a pension or been a member of a pension scheme throughout your working life. For example, have you paid into a pension for the majority of your career, such as 20 or more years out of, say, 25 years work? Put it another way, do you think you've been a member of a pension scheme for at least 80% of your working life so far? Whether you've taken full advantage of employer contributions or made sure your employer has matched your contributions where they will, because this can significantly increase your retirement savings. Have you utilised all the available tax relief to maximise the benefits of your pension contributions, helping you reduce your taxable income? If you've been a higher rate taxpayer, have you definitely claimed back your higher rate tax relief? The type of pension scheme you've enrolled in, whether it's a defined contribution or defined benefit plan, and how it aligns with your retirement goals is also vital. Whether you've made additional contributions to personal or private pensions aside from any pensions you've had through work. Even small amounts per month over a long period of time, or small amounts contributed a long time ago, can grow into something seriously meaningful. And lastly, does anybody remember opting out of SERPs? This was hugely popular in the late 80s and early 90s, and if you did this, some of your national insurance contributions were redirected into either your works pension or quite often a separate private pension. If you did this, or think you did this, you may have a pot of money sitting around somewhere that is worth more than you think. If you're confident in your answer to these questions and you've paid into a pension for long enough, you're 1/5 of the way to very possibly being able to retire right now. Question 2. Are you mortgage free or have a small balance left? Being mortgage free means you have no monthly payments and might have some disposable income which can be used to boost your retirement pot, or it could be used for travel or hobbies, etc., etc., when it comes to actually retiring. Or do you have a remaining mortgage? If you do, your monthly payments will definitely reduce the income available for your retirement, and that might affect your financial flexibility. So if you haven't paid your mortgage off yet, it's absolutely vital you've got a clear plan for your outstanding balance. That doesn't necessarily mean paying it off, well, not immediately anyway. Mortgages can now extend into retirement with some lenders, and it might be preferable to keep paying your repayments rather than taking the 25% tax-free cash from your pension to pay it off, because this may well result in a higher tax burden longer term. In fact, you might even consider switching to an interest-only mortgage to reduce your payments. That makes retirement even more possible, perhaps on the basis that you intend to downsize at some point and pay the remaining mortgage off then. It's all about understanding the options and making good decisions that are exactly right for you. At the end of the day, it might not be a bad idea to seek financial advice. It's definitely vital to do that before using tax-free cash to pay off a mortgage, for example, because that really could mean you shoot yourself firmly in the foot, so to speak. And to be frank, and this is a bit of a shameless plug, I want to mention that if you're watching this and you're not currently working with a financial advisor and you want that security in your retirement planning, we're currently offering a completely free retirement review valued at £800. So if you do want that security as you retire and you think it would be valuable to speak with someone to assess your situation, to help you come up with a game plan for your retirement, just head to the description or go to www.reevesifa.com. Now, question number 3. Do you intend to continue to work into retirement? This is a pretty simple question on the face of it, but you need to think really carefully about what is possible and desirable in terms of working after retirement, either for financial reasons or personal satisfaction. For instance, lots of people don't simply hang up their work boots on a Friday and never work again, but instead they do something that we call phased retirement. This is a flexible approach where you gradually reduce your working hours over several years instead of jumping straight into full-time retirement. What are the benefits of phasing into retirement? Well, let me tell you. Well, for many people, the idea of stopping work altogether can be pretty daunting, and in fact for many completely unappealing. What on earth am I going to do with my time? I often hear them say? Well, instead of working full-time for longer and then suddenly retiring, consider transitioning into semi-retirement. By working part-time, you can enjoy the best of both worlds. More free time now and a smoother transition into full retirement later. It also makes the transition from full-time work to retirement a wee bit smoother, both financially and emotionally. I mean, there must be some people at work you quite like, maybe. Continuing to work part-time can provide a bit of steady income. It'll help you cover living expenses and keep you financially secure. That then means your pension savings can keep growing, reducing the chances of you running out of money later on. And remember, you don't need to stay working where you are. I know lots of folks who ditch the day-to-day stress of their current job and go to work somewhere else, perhaps a little less taxing. They might be driving for Amazon or a supermarket delivering groceries, or they might even turn a hobby into something that pays. It's an opportunity to change your lifestyle and your life. Here's some food for thought. After working for 30 years, I expect you're pretty good at what you do. Maybe you've specialized in a particular field. You could pass that knowledge on as a consultant, say a couple of days a week, earn £250 a day, £2,000 a month. This would keep you earning, feeling productive and useful, and allow you to ease into retirement while still enjoying your free time. Plus, not having to rely fully on your pensions and savings will mean they'll last longer. Right, let's move on to question number 4. Do you have a plan for your house? Even though this question can be answered simply yes or no, it is a little more open-ended, or certainly should be. So for example, do you plan to stay in it forever? And if so, would you be prepared to free up some of the equity later in life to fund your retirement? What about downsizing? Would you do that now? Or if not, would you do it later in life? If you're willing to consider freeing up equity one way or another, then alongside everything else in this video, you could be ready to retire. But here are some more property matters that you should consider before making any decisions. Downsizing. It can go poorly if you're not planning it properly. Many retirees move to smaller homes, but they end up spending the same or more due to better locations or paying for renovations. But if done right, it can free up significant amounts of cash. For example, if you decided to sell a home that's become too big for you, which we often refer to as rattling around in it, and move into something smaller, let's say that released £150,000. That could probably deliver £1,000 a month quite comfortably for 15 years or so with some sensible investment. And for those who don't want to move home, there is equity release, and that involves unlocking some of the value in your home to provide additional funds. You do that either through a loan or by selling part of the property. For example, if you chose to use equity release in your property and unlocked £50,000 of its value, you could use that money to pay for home renovations, cover healthcare costs, or just simply add it to your retirement pot for use later. This would allow you to remain in your home without selling it, which is very attractive to lots of people. Of course, you could simply choose to plan around leaving your home to your family and spending everything else, which is absolutely fine. And finally, question 5. Have you built up savings elsewhere? It's really common for people to save up emergency cash reserves that are actually way more than they really need. If that's you, and you have a bit of a nest egg sitting in the bank or building society, you might consider using some of this to add to a pension. Taking £10,000 that you probably won't need until you retire and contributing it to your pension will boost it immediately to £12,500 thanks to tax relief from HMRC. That's a healthy 25% wealth boost, and there's more tax relief available if you're a higher rate taxpayer. It's free money, folks, so definitely worth considering. Even small lump sums can make a huge difference over the years to come. You might also want to factor in inheritance, but only if you are certain you're going to receive it. Not many people receive huge inheritances, although a decent amount can go a long way. If you're expecting some money from family, think about these options. Paying off debts. Well, inheriting money could allow you to clear outstanding debts like a mortgage or loans, improving your financial freedom and security. You could boost your retirement savings. A windfall might provide a significant boost to your pension pot or other savings, helping you retire earlier or more comfortably. Improved financial flexibility. An inheritance could also provide the freedom to invest in opportunities like property, travel, or even starting a new business. Let's give you an example of how an inheritance could boost retirement savings. If you inherited £75,000, subject to earnings and allowances, you could add this to your pension fund, and with basic rate tax relief alone, it would turn into £93,750, which is, as I said before, a very healthy 25% return, practically overnight and with zero investment risk. For higher rate taxpayers, there's an additional £18,750 worth of tax relief available, meaning you only need to spend £56,250 to get £93,750 into your pension. Well, that's a whopping 67% return. It's this kind of lateral lateral thinking that could get you retired today. So if you answered yes, or you're looking good in all 5 departments, then you could very well be on the cusp of immediate retirement. And after watching this, you might be curious about what regrets someone might have about their retirement if it didn't necessarily go to plan. So click here to find out what 44 regrets about retirement that I wished I knew in my 40s, so that you can avoid making the same mistakes and get a little bit closer to being able to retire properly. I'll see you over there.